Welcome back to the weekly Crypto Roundup, the show that cuts through the noise and brings you everything that actually mattered in the markets over the last 7 days. And what a week it's been. This one felt like the kind of week where nothing moved. Until you look underneath the surface and realize everything was moving. Bitcoin threatened a proper rebound early on before slipping straight back into a cautious consolidation. Traders who thought the worst was over found the market reminding them very quickly that we're not in a clean trend yet. And across the board, leverage vanished at one of the fastest rates we've seen in months. Corporate treasuries that went big on crypto started facing their toughest few weeks of the year, and institutional flows into ETFs delivered a very strange mix of caution and conviction at the exact same time. It's been a week that didn't give you fireworks, but if you pay attention, it gave you signals. Strong ones. Before we dive deeper, I want to say a massive thank you to everyone who continues to support the show. We are now only about 80 ratings away from unlocking the next 50 XRP giveaway milestone. And remember, we're giving 10 XRP to the comment of the week and 5 XRP to a second listener, and we'll reply directly to your comments to collect your address. We're doing this every Friday up to Christmas, so keep the comments coming. Even a quick emoji keeps you in the running. Now let's get into what actually shaped the crypto market this week, because there were a handful of stories that really mattered. Stories that tell us exactly where sentiment is, where liquidity is flowing, and what we should expect going into next week. One of the biggest narratives this week was Bitcoin's attempt to pull itself off the floor. There were moments, especially midweek, where it genuinely looked like Bitcoin was trying to retrace higher. Funding rates stabilized, liquidations slowed down, and we saw spot buyers starting to step back in. But every time Bitcoin pushed toward reclaiming higher territory, sellers met it almost instantly. Analysts described it as a market that wants to go up, but doesn't have the confidence to commit. One analyst, Marcus Thielen, said on Friday that Bitcoin is stuck in a hesitation zone. Not a bearish zone, not a bullish zone, a hesitation zone where traders are simply refusing to take the first step. So the story isn't that Bitcoin fell off a cliff or that it rallied hard. The story is that it showed enough strength to get some eyebrows raised, but not enough conviction to spark a proper move. And when Bitcoin hesitates like that, the rest of the market usually does the same. But that hesitation didn't stop something far more dramatic from happening behind the scenes. We saw one of the biggest unwinds of leverage in months. More than $1 billion worth of leveraged positions were wiped out this week across Bitcoin, Ethereum, Solana, XRP, Dogecoin, and more. And it wasn't just long positions being hit, shorts were also getting liquidated. This type of two-sided washout usually signals that the market is trying to reset itself. It's the equivalent of flushing the pipes. When too many trades are built on leverage instead of real demand, the market becomes fragile, and one sharp move forces a chain reaction. That's exactly what we've witnessed. Several exchanges reported some of their highest liquidation days since early autumn. And strangely, that's often bullish longer term. Because once leverage is flushed out, the market can start to build again on something more stable. This doesn't guarantee a rebound next week, but it does mean the groundwork is being laid. While the trading side of the market went through a violent reset, corporate treasuries that heavily invested in crypto had a rough week too. A few smaller listed companies who publicly disclosed Bitcoin purchases throughout the year saw their quarterly filings fall under pressure. Their share prices dropped, not dramatically, but enough to show investors were reacting to crypto volatility. And this is a reality we don't talk about enough. When companies put Bitcoin on their balance sheets, they're effectively putting their reputation and stock price on the line with it. We already know about MicroStrategy playing the long game. But some of the smaller firms with far less liquidity and far less investor trust are struggling right now. Their treasury decisions looked brilliant when Bitcoin was pushing new highs. But when volatility bites, these companies feel the pressure more than Bitcoin itself does. The interesting part is that none of these companies appears to be selling. So even though their share price gets hit, their conviction is unchanged. And conviction matters. Because if smaller corporate treasuries keep refusing to sell during red weeks, it reinforces the institutional idea that Bitcoin is a long-term asset and not a speculative punt. Now we need to talk about ETFs, because this week showed a fascinating split between different types of crypto ETF products. On one hand, spot Bitcoin ETFs saw mild inflows, nothing huge, nothing dramatic, but enough to show that institutions are still accumulating. On the other hand, Ethereum ETFs had a rougher time, with a few minor outflows mixed in. But the real story that surprised people was in the altcoin trust products. Grayscale's trusts for XRP, Zcash, Dogecoin, and Chainlink all saw movement this week. One of the first times in months where there was noticeable activity across multiple non-Bitcoin assets. XRP and Chainlink saw the most interest, with analysts pointing out that XRP is still sitting at a discount, making it appealing to some investors looking for longer-term exposure. Chainlink, meanwhile, has attracted serious attention because of its real-world asset partnerships. Dogecoin and Zcash saw smaller movements, but the fact that money is flowing into these trusts at all suggests institutions are preparing for wider diversification, something we talked about in a previous episode. This aligns perfectly with what we said last week. Institutions don't buy altcoins when retail is euphoric. They buy them when retail thinks the market is dead. We're going to take a quick break. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
That brings us to another repeating pattern this week. Stablecoins quietly rising again. Whenever stablecoin inflows begin to trend upward, it usually signals that fresh liquidity is on standby. It's one of the oldest, clearest signals of potential market recovery. Stablecoins don't lie. You don't convert dollars into USDT or USDC unless you plan to deploy them. And this week, we saw an uptick across multiple chains. Analysts like Kai-Young Ju highlighted this trend earlier in the week, explaining that even during periods of price stagnation, stablecoin positioning can reveal the real intentions of larger investors. And right now, those intentions seem to be leaning toward accumulation. That doesn't mean an immediate pump, just that money is preparing for something. But even with those signals, this was also a week where the numbers reminded everyone why crypto is still crypto. The market wiped out more than $1 trillion in combined value from the high point of the previous cycle to the current market structure. It's not new information, but sometimes the scale of it hits people all over again when analysts bring the numbers back into focus. Several major research firms published reports this week showing that more than half of altcoins are still down 70% to 95% from their cycle peaks. Meanwhile, Bitcoin has erased almost all of its cycle drawdown. It's a reminder of how asymmetric this market is. Bitcoin behaves like a macro asset. Altcoins behave like lottery tickets. And yet, somehow, both sides always converge when the market eventually turns. This week was full of reminders like that. Reminders that volatility cuts deep, but opportunity does too. There's another story that didn't dominate headlines but absolutely shaped sentiment. Several security incidents across different ecosystems. Nothing catastrophic, but a handful of medium-sized exploits and fraud cases made the rounds. And these things matter because they chip away at trust during already fragile weeks. A few DeFi protocols suffered losses, a couple of Web3 gaming projects had token issues, and there were some isolated exchange-related concerns. The good news is that none of these incidents turned into the cascading events we've seen in tougher years. The bad news is that retail sentiment is always sensitive to security scares, and it added to the overall cautious tone this week. Still, the industry is getting better at containing these problems quickly, something that would have been unheard of 2 years ago. Now, looking ahead to next week, there are a few narratives shaping up that could genuinely move markets. The first is the ongoing macro backdrop. Rate cut expectations remain mixed, but traders are paying attention because global economic data next week could either reinforce the idea that cuts are coming sooner or push them further into 2025. Crypto has become extremely sensitive to macro trends again, and Bitcoin especially tends to react to rate expectations before anything else. Analysts like Mike McGlone pointed out this week that Bitcoin's long-term structure is still incredibly strong compared to other risk assets, and even if next week brings volatility, it's unlikely to change the broader trajectory. We're also heading into one of the most seasonally interesting parts of the year. Historically, the final month of the year has produced some of crypto's biggest surprise moves, both good and bad. Traders know this. Institutions know this. And combined with stablecoins rising and leverage being flushed out, it sets the stage for an environment where a single catalyst can push the market sharply in either direction. It doesn't mean we'll see a huge move next week, but it does mean the potential is higher than normal. And finally, next week could bring more clarity about ETF flows heading into the end of the month. If Bitcoin's inflows increase even slightly, it could begin to shift sentiment. If they taper off, then we may see sideways chop continue. Either way, the market is paying attention. Make sure you're following the show so you never miss an update, and keep the comments coming. Every interaction genuinely helps us grow and helps us bring even more back to the community. Thanks as always for listening, and we'll see you at the top.